Hello again, everyone. We're here to help you get through the last of Module 2. I am Professor West, and this is my good friend and colleague.
Professor Valentine, howdy.
And once again, we know most of this material, so hopefully we can pass it on to you. Now, Professor Valentine pointed out to me a couple of things that we forgot to talk about in our last lecture. One of those is the difference between prime cost and conversion cost. And the other one is the difference between average cost and marginal cost. So, Professor Valentine, tell me a little bit more about this idea of prime costs and conversion costs, because when I tend to think about these, I think about the Venn diagram that looks something like this. So if I think about the two circles, I think about this one over here as my prime costs. And that's what I think about as my conversion costs. So how do I fill in the blanks?
Well, your prime costs are those activities that you are, activity is not the right word I want to use, but those units that you actually need to create a product. And so that will be your direct materials is going to be, direct materials is going to be in that circle, and then the direct labor.
Okay, so I got material and labor together in my prime costs. Those are the things, as Professor Valentine said, are have to be there. They are directly associated with the product. Okay.
Correct.
And so the conversion, however, we've got this space over here. What goes in over in this other circle? So I got direct labor in here, but what am I missing?
Now you're missing manufacturing overhead. So there are two ways you can think about this. You know that your three product costs are materials, labor, and overhead. But the other way you can think about this is that the conversion cost is the effort that it requires to create a product. So that effort is going to be direct labor and all the other utilities and such that it takes to bring a product from materials to finished goods.
So these are the costs that you incur to convert the material into some finished product.
Exactly.
So that's the key for that one. Okay, let's talk a little bit about average cost versus marginal cost. Average cost we spent a lot of time on last lecture. And as you pointed out, it's just the total cost, or the Y, divided by the X. So that is average cost. Now, but what is marginal cost?
Marginal cost is the real cost to make one more widget. So we know that if we have our fixed costs, our facilities, and all the depreciation and that sort of thing, that's going to happen regardless of the volume, and that's going to be constant regardless of the volume. But in order to make one more of whatever we're making, we're going to incur direct materials, we're going to incur direct labor, we're going to incur variable overhead. So all those total variable costs are the marginal costs to make one more unit.
So in this case, our variable costs per unit are the marginal costs, because when X goes up by 1, the only thing that changes when it comes to total cost is going to be one more unit of N.
Exactly.
Okay?
Exactly.
So make sure you differentiate between those two. Those are going to come back and haunt you at different points in the semester. So cost behavior is critical here. You've got to be able to handle that piece. And so one of the elements of that we took you through in our last lecture when we said, okay, let's take a look at this problem. So we worked this problem last time, showed you how to get the Y is equal to mx plus b. Out of that, we showed you the behaviors. And so now we want to go through and say, okay, if I don't have that much information, let's take a look at other ways that we can go about estimating our cost equation. So when we talk about estimating a cost equation, we're always estimating the Y is equal to mx plus b. That is the cost equation. And so we've got 3 ways to do it. The first way is a scatter graph. The other one is high-low. The other one is regression. okay? And so we're going to start with the most fundamental, which is high-low process, okay? And so this is one of the situations, and Professor Valentine talks about this a lot, where I have one cost, but I have multiple periods of information, okay? So I've got a lot of periods, a lot of data, but I'm only dealing with one type of cost, okay? So I'm trying to decide how much of that cost is variable, how much of it is fixed. And so if I go back over to my spreadsheet now, we can look at this same data and go through the process. So when I talk about this, we always have 5 steps. First thing you've got to be able to do is identify the high and the low point, okay?
Now, what's key with that is typically students will go straight to the cost. Take the high cost and the low cost. That high and low point is based on your high and low activity, your high and low volume.
Well, high and low has to use this column, not this one.
Yes.
Okay.
Now, 99% of the time, they're going to correlate. But I have been known to see an exam where they didn't coordinate as well. I'm not saying, I'm just saying, you know, that
he was looking at my exams. And so you'll see that in one of the other problems that we've set up for you. So always think about these things as pairs.
Yes.
These are always pairs. So if the high volume was 2150, the cost associated with it was 61. Okay.
Yes. Yeah, because the other thing, like going back to what we were just talking about, a lot of students, when they don't correlate, they'll take the high volume, let's say in November, and then the high cost if it were in July. And no, they have to be pairs. Very good.
They have to be pairs. So you might remember from the old days, this is where you have that XY pair, and you're doing your math, your algebra between those two XY pairs.
Yep.
So in this case, the volumes we have set up, the high and the low volumes are 2150 and 850. So the 2150s here, the 850s here, okay? And so as Professor Valentine pointed out, you take those things in pairs. And so there is his Y and his X. And those are his 2 pairs, okay?
Yep.
So step 2 was compute the difference. And this is going to be really important when we talk about, when Professor Valentine comes back and talks again about this idea of what changes when volume changes. And so the change here is the difference is 1,300 in terms of units, which means that at the low, we were at 850, and it went up 1,300 to this volume at the high. So 1,300 is the change, or the delta. Same thing with the cost. Our low cost was 29, high cost was 21. So the cost changed by 32.5. And one of the things that Professor Valentine told you is the only reason that these total costs could change is because of the variable cost. The fixed cost doesn't change. The fixed cost doesn't change. We draw you back to the 2 assumptions. One, it's a linear cost, so I can draw a line between those 2. The other one, those costs, that cost structure stays the same inside a relevant range. Inside a relevant range. So in this case, I tend to think of the relevant range for this example as the difference between the 2150 and the 850. Yeah. I know data in between those points. If I came back and asked you, oh, let's estimate cost at 5,000 units. I don't have very much comfort in the fact that 5,000 is going to be the same as 2150 or have the same cost structure, because there's economies of scale and volume discounts and all those kinds of things.
You'll get a number. But the
Yeah, he
point is,
will.
is it going to be meaningful based on the data that you have? So yeah, outside the relevant range, all bets are off.
And at this point, he would also tell you on one of my previous exams, or many of our previous exams probably, we'll ask you to estimate costs outside the relevant range. And at that point, you just say, I'm not going to do it. I can't do it. You told me I shouldn't do it. And so that would be one of those questions where we're just trying to find out if you're paying attention to the relevant range. So if we move on to step 3 here, Eric, what happens next?
So we divide the cost, the change in cost, by the change in volume.
Okay.
So that's going to give us our M.
So you've gone through this process and said, okay, if the costs change only because of volume, then what you've looked at here is to say, okay, MX, if I know the total of MX is this difference of 32.5, and I know the change in volume was 1,300, I can solve for the X.
Correct.
And so that was his $25. All right.
Correct.
Cool.
Yes.
So
Yeah.
at that
So
point,
and
go ahead.
that's the slope. That's the slope of your line. Yeah.
Okay. So that's the slope. Always remember that's the slope. Okay. Any questions about that? So at that point, I think it can also be helpful to think about, all right, let's just continue that cost equation discussion. And now look at y is equal to mx plus b. And what I've done is I've kind of put it in here as a just spreadsheet form, the easiest way to do it. But this is one of those calculations that I think is easier by hand, just because I have the equation down, right? Yeah. So in this setup, you also have to decide whether you want to calculate your fixed expenses at the high or the low level. Doesn't matter, just pick one. It doesn't matter, just pick one. So I tend to work at the high level, okay? And so, and then Eric, I'll let you you'll go through this again, but at the low level, and so that way we can see it both ways.
Sure.
So the Y, in terms of the total cost, is the amount that I just covered up and can't see. It's the 61,750. I know my M is 25. And I also know that at the high level, my volume was 2150.
Correct.
So if this is 2150, those things together are going to be the 53,750. And when I solve for B, that's going to be $8,000. That's my fixed cost. So my actual equation is going to be Y is equal to 25X plus 8,000.
Yes.
So let's go ahead and take a look at this again, though, if you choose to work from the low volume, okay? So if I take these things out, okay, so at the low volume, what was our total cost?
29,250.
Okay, so I got the 29,250. Okay, and do you remember what? I don't remember what the volume was at that level.
850.
850. Okay. So at that point, if I multiplied the 25 and the 850 together, I know that'd be 21,250.
Mm-hmm.
And then you just solve for B. And in this case, the B is going to be
8,000.
still 8,000.
You know, it's such a simple calculation. I tend to advise students to do them both ways because, you know, if you come up with two different answers, you did something wrong. And, typically what that will show you is that you have not paired your cost and your volume together. Because if you don't pair your cost and your volume together, you're going to come up with two different answers.
Yeah, and this way, the other thing that I see people make a mistake with, so you have the wrong pairs, or you use sales, not cost.
Right.
So sometimes people will, if you're looking at an information about income statement, then you get a sales number. And if you put sales in there, we'll show you that again in a little bit. But if you wind up with a fixed cost of 0, you know you've made a mistake. This is not a good day for you. So we'll highlight that again a little bit later. Well, let's finish up, Eric, with one last piece over here doing scatter plots or scatter graphs. And this is just the classic setup from Excel. A couple of things that you have in this handout. This is the data that we had on the previous problem. So you'll see exactly the same data that we had over here. And you got to be able to create this scatter graph. And to do it, I included a screenshot of Excel. So you'll find the command under the insert tab, and then you have to go over here to the charts, and you're going to insert a scatter graph. Okay, and so the way that works is I'm just going to highlight this information. Go to insert scatter graph and call it a day. I mean, that's essentially it. Okay, so those are the pieces. Now, the other thing you notice here, this was the high-low issue. Okay? Because in high-low, we're only using 2 points. This low one, which was the 850, and the high one, which was the 2150, I think?
Yeah, 2150.
Okay. Now, what the high-low does is draws a line between those 2 points. That's fine, but it does ignore all the other points, all the other information.
Yeah.
So what you can do here is insert this trend line. And we also gave you that information. So if you right click, if you hover over the data points and you right click on that, you get this trend line information. And that'll put in the trend line, and then you can also do some description. So when you talk about scatter graphs, Eric, and some of this information, what else do you try to let people know about this compared to, say, the high-low?
Well, the biggest deal is the biggest difference is that you have more data that you're encompassing with the scatter plot method, because it's basically the trend line over a regression.
Okay.
So
this is a regression equation, is what you're
correct.
saying.
Yes.
Yes. So Excel uses regression in the background to calculate this line, the equation for this line that they put in as their trend line. Okay.
Right. And so you have two ways to determine how good that line is. One is the R squared. Just kind of shows you what the goodness of fit, or how well the line represents the data. The other way is to you have these visual representations, so you see if you have outliers. You know, you know that if you have one, you know, 1,500, you know, if you have data points that are completely off of the line visually, then you may have to make some some other statistical assumptions. But the scatter plot is good for just eyeballing those anomalies.
Yeah, see if it even looks linear to begin with.
Hmm.
And as he points out, this R squared, the maximum is 1. So he's getting closer to 1, which means that this variable, volume variable, it's explaining 75% of the change in the cost variable. So when he talks about goodness of fit, that's the idea. How much does this actually tell me about the predictability of the costs?
Yeah.
So if you've had business stats, you might recall some of those things. We're not going to go a whole lot deeper into it than that. But that's kind of the setup that we have. Anything else, Eric, about this estimation of costs?
I think that's it for me. I think
Okay. Well, the whole point of these was trying to get an equation for a line. You can go through
yes.
any of these, but the reason is we're trying to get to that equation for the line, and that's what sets up module 3. The other thing I've noticed is once I draw some of these things, I also can get a nose and a face. So with that, we're going to call it a day and get out of here. I always like to leave on an old man joke. So there's one for you. Have a great rest of your day. Professor Valentine, shall we say goodbye?
We shall. We'll see
All
you.
right. Bye
Take
all.
care. Bye.